In September of 1998, most Americans had never heard of long-term capital management. Most people in the world had never heard of it. And yet, somewhere in that September, the retirement savings, the pension funds, and the financial security of millions of ordinary people who had nothing to do with it came within days of being wiped out. Not because of a war, not because of a government, because of a private investment fund, a club for wealthy investors operating out of offices in Greenwich, Connecticut, that had borrowed so much money and made so many financial bets that when those bets went wrong, the entire global financial system nearly went with them. How does that happen? How does a private fund that most people have never heard of come within days of collapsing the savings of millions of people who had no idea it existed? The answer starts on September 23, 1998, in a room at 33 Liberty Street in Lower Manhattan, inside the offices of America's central bank, the institution whose entire job is to prevent exactly this kind of crisis, where 14 of the world's most powerful bankers had been summoned and given an ultimatum. Put up billions of dollars to rescue a fund you did not run and were not legally required to save, or live with what happens next. The Federal Reserve had no legal authority to rescue it. All it could do was make a phone call. This is black box markets. Let's open the black box. To understand how a private fund ends up in a room like that, you first need to understand one simple idea, because everything that follows comes from it. Imagine you drive past two gas stations on opposite sides of the same street. One is charging $2.69 per gallon. The other is charging $2.71. You know from experience that within a day or two, one of them will change its price to match the other. They always do. So you make a bet. You lock in the cheaper price at one station and the more expensive price at the other, and you wait for the gap to close. When it does, you pocket the difference. That difference, 2 cents per gallon, is tiny. On its own, it is worthless. But what if you could make that exact kind of bet on thousands of financial products at once? Government loans, interest rates, currencies, all around the world simultaneously. And what if, instead of using your own money, you borrowed enormous additional sums to multiply your returns? That practice, borrowing money to make bigger bets, is called leverage. It is not a complicated idea. It just means this: when you are right, your winnings are multiplied. When you are wrong, your losses are multiplied too. And the bigger you borrow, the bigger both outcomes become. This was the machine that a Wall Street bond trader named John Meriwether built when he founded long-term capital management in 1994. And the men he hired to run the mathematics behind it were not just any mathematicians. Two of them, Myron Scholes and Robert Merton, had spent decades building the formulas that the entire global financial industry used to price exactly these kinds of bets. The formulas that told you how risky a position was, how likely it was to go wrong, and how much you could safely borrow against it. In October of 1997, those formulas won them the Nobel Prize in economics. They had the Nobel Prize to prove the machine was safe. For 4 years, the machine worked exactly as promised. Long-term capital management returned between 20 and 40% to its investors every single year. Extraordinary numbers, delivered with an apparent certainty that made the fund look less like a trading operation and more like a money-printing machine that happened to be run by the most credentialed people in the room. The world's biggest banks lined up to lend it more. By 1998, the fund controlled approximately $125 billion in investments, on a base of less than $5 billion of actual investor money. For every $1 of their own capital, they had borrowed roughly 25 more. And in financial contracts, bets on whether prices around the world would rise or fall, the total value of what they held was over $1 trillion. $1 trillion. Run by fewer than 200 people, built on models that said, with mathematical confidence that the risk was under control. There was, however, one thing the models had not accounted for, and it was not a small thing. Every major bank in the world had been looking at the same models. They had all been trained on the same mathematics, and they had all, quietly, made almost exactly the same bets. Nobody had noticed. Nobody had asked what would happen if they all needed to get out at the same time. On August 17, 1998, Russia announced that it could not pay back the money it had borrowed. When a country does this, when it tells its lenders that the debts will not be repaid, it is called a default. It does not happen often, and when it does, it sends a wave of fear through financial markets that is very difficult to contain. What followed Russia's announcement was a worldwide panic, the kind that the Nobel Prize-winning models had calculated was almost mathematically impossible. Investors everywhere simultaneously decided they wanted out of anything that felt risky and into the safest things they could find. United States government bonds, loans to the American government, considered the most reliable investment on earth, suddenly had everyone desperate to buy them. Everything else had everyone desperate to sell, including long-term capital management. The prices of everything the fund owned started moving in the wrong direction, not narrowing, as the bets had predicted, but widening as panic spread. Losses began mounting, and here is where the flaw in the architecture became catastrophic. To sell a position, to get out of a bad bet, you need someone on the other side willing to buy it. But the banks that would normally have been natural buyers had made the same bets as LTCM, using the same models, pointing in the same direction. They were trying to sell too. Where had all the buyers gone? They had never existed. The models had assumed that in any moment of stress, there would always be buyers on the other side, that markets would remain orderly, that panics would be short-lived, that the mathematics of probability would hold. What the models could not account for was a world in which every major financial institution had been shaped by the same thinking and was now trying to do the same thing at the same moment. There was no one on the other side. The machine had eaten itself. On August 21st, long-term capital management lost an estimated $550 million in a single day. The partners told themselves it was temporary, a market dislocation, the kind of thing the models said would correct itself. They were wrong. The losses continued. By the end of September, the fund had lost approximately $4 billion in a single month, more than 80% of everything it had ever built. And the equity that had once supported $1 trillion in financial bets had fallen to something close to $600 million. At that point, the situation became a countdown. Long-term capital management was days, possibly hours, from a forced collapse, in which every position would have to be sold simultaneously into a market with no buyers, crashing prices across every asset class the fund had touched, and triggering losses at every bank that had lent to it or mirrored its trades. The losses each bank faced ran into hundreds of millions of dollars, not because any single one of them had been reckless, but because they had all trusted the same models, which had pointed them all to the same place, at the same time, with borrowed money they could not afford to lose all at once. And America's central bank, the Federal Reserve, the institution created specifically to prevent this kind of systemic collapse, had no legal tool to stop it. It could not lend directly to a private investment fund. It had no authority to regulate what LTCM had been doing. The laws that governed what the Federal Reserve could do in a crisis had never imagined a private fund, invisible to regulators, controlling over $1 trillion in financial exposure and sitting completely outside the reach of every rule that existed. So it made a phone call. On September 23rd, Peter Fisher, the Federal Reserve official responsible for managing financial markets, gathered the chief executives of 14 banks at 33 Liberty Street and laid out the numbers. The fund was failing. A disorderly collapse would mean simultaneous correlated losses across the entire system, all hitting at once, from the same direction, the scenario the banking system was least built to survive. There was no government money, There was no legal mechanism. There was only the question in that room. Would they, voluntarily, put in a combined $3.6 billion to take control of the fund and wind it down in an orderly way? By the end of the afternoon, they said yes. The crisis was contained. The rescue worked. And almost nobody outside that room knew it had happened. Long-term capital management was wound down over the following year. Its investors lost most of what they had put in. The partners, many of whom had their personal savings inside the fund, lost fortunes. John Merriweather eventually started another fund. The models were not thrown out. They were refined, updated, and put back to work, because the financial industry that had been built on them had no alternative framework to replace them with. The regulatory rules that had allowed a private institution to accumulate $1 trillion in financial exposure with no public oversight, no regulatory visibility, and no legal mechanism for intervention were not changed. The meeting at 33 Liberty Street had worked, so the lesson the system took from it was not that the rules needed fixing. The lesson was that 14 banks could always be put in a room. 10 years later, in 2008, a much larger version of the same failure arrived. The same borrowed money, the same mathematical models applied across the same asset classes by the same institutions, all pointing in the same direction. The same discovery, when the moment came, that everyone had made the same bet, and there was no one on the other side. That time, 14 banks in a room was not enough. The bailout required hundreds of billions of dollars of public money from taxpayers in countries around the world, people who, like the people of 1998, had never heard of the funds that had failed them. The Nobel Prize and long-term capital management's collapse were 12 months apart. That is what the black box of long-term capital management contains. Not recklessness, not greed. A machine that was mathematically perfect, right up until the moment every institution using it tried to do the same thing, at the same time, in the same direction, with borrowed money none of them could afford to lose. And a system of rules that had left the most dangerous financial structure in history sitting completely outside the reach of every safeguard built to contain it. So that when the moment came, the most powerful financial regulator in the world had no tool available except a phone call and a quiet room at 33 Liberty Street. Subscribe if you want to keep opening them.